What are you investing for? How long are you going to invest? How much time are you willing to spend on it? And how much risk are you willing to take? These are the four questions that you need to ask yourself before investing. And the answers all depend on your personal situation. Today we'll discuss why these questions matter, what you need to think about when answering them, and why you need to do it before investing. So let's get started. First things first. Before you invest, you need to know what you're investing for. Do you want to become financially free and retire early? Or do you want to support your kids through college? Or maybe you want to buy that dream house in Italy. Whatever the answer is, it's important to know how much that will cost. Calculate as precisely as possible how much you would need to achieve that goal. This will give you a specific number to work towards, which can be a huge motivator when starting to invest. Now you're not just trying to make more money, you're actually working towards something. You're working towards a finish line. For some, it might be a simple number, like the price of a certain house you want or the cost of college tuition. But if your goal is to retire early and live off your investments, you need to know how to calculate how much you'll need in your investment portfolio. Some people might have heard about this concept from FIRE, which stands for Financially Independent Retire Early. And this basically means that you need an investment portfolio where the annual interest earned on your investments will provide the income to pay for all your yearly expenses. Or in other words, that you can live off the money that your investment portfolio is making. I'll give you a simple example. Let's say your monthly expenses are $2,500, which means you'll need $30,000 a year to pay all your expenses. The idea is that you build an investment portfolio that makes on average around $30,000 a year. Most people use the 4% FIRE rule to calculate how much they need in their portfolio, but you can play around with this number depending on your investment style and average yearly return. The calculation in this case would be 30,000 divided by 0.04, which is 750,000. So to sustain a lifestyle of $30,000 a year, you need to have an investment portfolio of $750,000. Ideally, that portfolio will then grow by 4% to 780,000, allowing you to take out 30,000 without hurting the principal, meaning you're still left over with $750,000 in your portfolio. This is a quick and simple explanation of how that works, but if you want to learn more about it, I've written a free guide which you can find in the description below, and that covers everything. The second decision you need to make is your time horizon. When do you need this money and when do you want to start taking money out of your investment portfolio? Short-term market movements can be very volatile and unpredictable. You don't want to have a sudden 30% downturn in your portfolio right before you need to take money out. So there are three major time horizons: short, middle, and long term. It's important to change your investment strategy depending on your own time horizon. If you have a short-term time horizon, meaning if you need the money in 1 to 3 years, you should either not invest it or only invest it in the lowest part of the risk spectrum. This could be a money market fund, for example, but you're probably better off looking for a high interest rate savings account. Because you're looking at such a short time frame, there's just too much risk investing it. Because investing is a long-term game where you're counting on the long-term averages. So if you're unlucky, you might just invest right before a big correction in the markets, or right before a recession like the one we're in now. And you don't have the time to let the markets bounce back, because that could take years, and those years you just don't have. When you're in the middle time horizon, meaning you need the money in say 5 to 10 years, you should still invest on the safe side. Have a higher allocation into income producing assets like bonds, dividend stocks, or real estate. These tend to be less volatile while also generating an income. If you're at the far end of the middle time horizon, you could decide to take on more risk, especially if there has just been a major correction in the markets, meaning that stocks and other assets have gone down in value a lot. If you're a young investor with a time horizon of several decades, you should definitely invest. You're able to take on more risks because the short-term market swings don't really matter. Even when you start investing right before a big correction, if you just continue to invest, you should be fine. You can invest in assets with a high growth prospect like the technology sector with, for example, AI, biotech, and even crypto. you have enough time to see these long-term investments hopefully fulfill their promises and change industries. The next decision you need to make is about effort. How much time are you willing to devote to your investments? If you don't have the time or interest, you should stick with ETFs, and if you have a long-term time horizon, you could also add some blue chip crypto projects like Bitcoin and Ethereum. There's nothing wrong with this. It's a highly effective, low-effort strategy and is probably best for 99% of investors. However, if you're willing to devote several hours a week to researching, you can allocate a portion of your capital to individual stocks and crypto projects. This way you can make more informed decisions about what to invest in and potentially make exponential returns with small investments. But to be honest, on average, trying to pick the winners, as they say, is a losing game. And most investors fail to outperform the broad market ETFs. The fourth and final question is about risk tolerance. How much risk are you willing to take on? It's easy to be a long-term investor in a bull market while everything is going up. But how will you react when the market drops 20 or 30%? You need to be able to stomach the volatility and short-term drawdowns and not panic sell when things get ugly. High growth investments may give huge returns, but they come at a cost. Even holding stocks like Amazon, Google, or Apple for years means you will have to endure several drawdowns of 20 to 40% along the way. Volatility is the price you pay for holding high growth assets. Of course, your risk tolerance is also partly determined by your time horizon. But even if you have a long-term time horizon, it's completely understandable if you decide to lean more towards a lower risk and less volatile type of investment strategy. Take the time to think about these questions and form a strategy that works for you. Write it down and come back to it from time to time, because maybe your situation has changed or your time horizon has become smaller and you want to switch your investment strategy. Thanks for watching. I would love to hear your answers to these questions in the comments below. And if you enjoyed this video, be sure to subscribe so you don't miss the next one.